There's a retirement account called a defined benefit plan that lets a self-employed professional shelter up to $300,000 a year in pre-tax income, completely legally, and your financial advisor will almost never tell you it exists. That's not a typo. $300,000 gone from your taxable income every single year. And by the end of this video, you're going to understand exactly how it works. But first, let me ask you something. You've probably heard of a 401k, maybe a SEP-IRA. Those are the accounts they mention on personal finance blogs, the ones every advisor brings up in the first 5 minutes of a meeting. The 401k lets you put away $23,000 this year. That sounds like progress, until you realize that a high-earning consultant, doctor, or small business owner in the 37% bracket is still handing the IRS six figures on everything above that cap. The system isn't broken. It's working exactly as designed, just not for you. Here's where it gets interesting. A defined benefit plan is technically a pension. An old-school corporate-era pension, except you own it. You set it up for yourself. The mechanics work like this. Instead of the IRS capping what you put in, a DBP asks a different question entirely. What income do you want guaranteed in retirement? You define the benefit first, hence the name. Then an actuary, a specialist who calculates risk for a living, works backward from that retirement number and tells you exactly how much you must contribute each year to fund it. Because the IRS lets the math drive the limit, not an arbitrary ceiling, the annual contribution can reach $345,000 depending on your income and age. The older you are when you set it up, the more you can contribute. Less time to fund the benefit means higher annual deposits allowed. Here's a real dollar example. Take a 52-year-old physician running a solo practice. She earns $600,000 a year. With a 401k and catch-up contribution, she shelters $30,500. With a defined benefit plan layered on top, funded annually, managed by an actuary, completely within IRS guidelines, she could contribute an additional $250,000 or more in pre-tax dollars. At her bracket, that's over $90,000 in federal tax she legally did not pay this year, not deferred in some complicated structure, just removed from the IRS's reach. And every dollar grows tax-deferred inside the plan until retirement, when she rolls it directly into a traditional IRA. And this isn't even the best part. The people running these plans quietly aren't just physicians. It's attorneys billing $700 an hour, management consultants with one anchor client and minimal overhead, real estate developers, any self-employed person or small business owner with high net income and a small team. They've had defined benefit plans for years, quietly, reviewed every 12 months by the same actuary their CPA recommended once in a corner office. The reason you've never heard about it. Most financial advisors at banks and brokerages don't set these up. They're not paid to. A DBP requires a third-party administrator, a licensed actuary, and a customized plan document, not a mutual fund with a quarterly management fee attached. There's no commission trail in it for them, so they move on. The school system never taught it. And the bank isn't calling on Monday morning to say, hey, want to pull $250,000 out of our taxable products this year. Now, here's the part they always skip. This plan has real teeth. Once you establish a defined benefit plan, you are committing to annual contributions. If your income drops and you can't fund it, the IRS notices. If you have employees beyond yourself, the rules may require you to fund a proportional benefit for them, and that changes the math entirely. This is not a set-it-and-forget-it account. It requires an actuary every single year to certify your required contribution. Done wrong, it's a compliance problem. Done right, it is the most powerful tax shelter legally available to a self-employed American. The IRS wrote these rules. They literally want you to save for retirement. The Internal Revenue Code says so. This is not a gray zone loophole. It's not aggressive tax positioning. It's in black and white. It's just that nobody ever walked you through it in plain English. Now sit with that for a second. If you're self-employed, if you're generating real income with real tax exposure, and you've spent years in a standard 401k, because that's what everyone pointed you toward, you've been leaving a six-figure deduction on the table every year. The question isn't whether a defined benefit plan can work for your situation. The question is how many years you've already paid full freight when you didn't have to. There's a related move that some business owners stack directly on top of this, a combination that can shelter even more and produce a completely different tax outcome at retirement. That's the next file.